when I was asked to write a paper for the Stiglitz Fresh Shrift, it seemed to me the right thing to do was to pick up the complaints that Joe had made and try and argue whether there was some way of making the DSG model fit for purpose. My experience in working in macro models is very much colored by the difficulty which is posed by the conversations between people who build theoretical models and people who do empirical, applied, detailed work. I was going to talk as an example of that, but I'll let those examples pass. And what I want to argue is that we need, for making both our understanding of what we were doing and those conversations between people who have simple models and those that do detailed applied work, some way of managing those discussions, and I'm going to talk to about that. It's helpful to go back and understand the role of simple models in macroeconomics. And of course, the place to start is thinking about what happened with the construction of the Keynes general theory. What made the ISLM model so important was that it resolved the controversies which remained. Richard Kahn produced the multiplier, and multiplier Keynesianism just seemed to be in contradiction with the classics, as in Keynes and the classics in Hicks's paper. And once the general equilibrium structure of ISLM was created, in which aggregate demand failures in the goods market could cause unemployment in the labour market, but in which there was an understanding of how monetary processes worked, and a conversation could be had with those who had been trained in the quantity theory of money, a conversation managed by the use of the LM curve. All of a sudden, there was a framework that stopped people having schismatic arguments and created a setup in which detailed empirical work could be done. And it was on top of a model of this kind that the Klein-Goldberger econometric models were built. They needed this simple framework rather than just being the empirical investigations of particular occasions. But what happened in the late 1960s was that this system, I'm going backwards to where we were, I know, there we are. There was where we were with this framework. And then the 1970s produced a collapse of that ISLM framework. And the core intellectual response to the 1970s was the rational expectations revolution, starting with the work of Muth. But what that revolution did was lead to two very different ways of thinking about the underlying structure of macroeconomics. One, the RBC setup, and secondly, the short-run stabilization policies of Taylor rule macro, which were formalized by Gali, Clarida, and Gertler. What I'm proposing as a framework for managing our understanding of the macro system is what I call a SENK model, simple new Keynesian DSGE model. And it's basically Smets, Wouters, Christiano, Eichenbaum and Evans, but those are moderately difficult papers to read. They're not the kind of paper that when you've read them, you think, I've got a simple analytical framework. This model that we're proposing is that structure with two rigidities, namely both nominal rigidities in prices, but also adjustment costs in capital. Here are the bits of this model written down in a list, and I'll come back to this list after showing you how the model works. But the list has an IS curve in which consumption and investment are separate, an investment function so that, unlike in the Ramsey model, all that's saved isn't automatically invested, but there are adjustment costs to investment, and Tobin's Q has to be sufficiently attractive to induce the appropriate level of investment, and explain what appropriate means in a minute. There's a production function which shows how labour productivity and its future expected behaviour feeds back on that value of Tobin's Q and thus on current investment. There's an equilibrium in which output is equal to aggregate demand, which can be different from aggregate supply, generating either inflation or deflation according to which way the demand goes relative to the supply. Of course, capital costs are essential in making this model stick together, because if in the Ramsey, as in the Ramsey model, when all of what's saved is automatically invested, you cannot have this aggregate demand managing the aggregate demand level mattering. Then, having built this theory of inflation dynamics, you need to close the model with something like a Taylor rule. That's the model. Here's two examples of how it works. Start with a negative productivity shock, let's say, of 10%, and look what happens. Output falls initially by slightly more than 10%, because although productivity has gone down, employment is also, L at the bottom, has gone down. So output falls by more than that initially. But because productivity has fallen, there is less need for capital. Long-run capital stock is lower. And so there's an immediate lower need for investment. That falls. So then you ask, how do you ensure full employment of resources? And I should make clear, this is a simulation in which I've overridden the Taylor rule and had a clever central bank which exactly interest rate in order to ensure full employment of resources. How is that done? By lowering the real interest rate R, and that lowering of the real interest rate means that consumption doesn't fall as much as it would in the long run. Consumers understand this long run, but with lower real interest rates, there's a temporary boost. The wage moves according to the straightforward labour supply function, and that's the structure of how a long run feature, a productivity shock on the supply side, works through demand and thus the whole structure of the model. Secondly, let's do the opposite sort of shock and have a cost push shock. Of course, if you had some backward lookingness in the inflation process, then you wouldn't need persistence in the shock, but this simple setup with a Calvo forward-looking inflation process, in order to avoid just having a spike, you need to have persistence. That's what's here. So of course, bottom right-hand corner, inflation starts off above its target. And that causes the real interest rate, the sub N on real interest rate, middle row, left-hand side, N doesn't mean anything, real interest rate rises. That depresses consumption, middle of the row, but it also depresses Tobin's Q and makes investment fall, and that fall in investment makes the capital stock K fall, and of course wages are depressed as a result of this happening. But gradually the economy goes back to an equilibrium, which if drawn long enough on this page would settle down with the same real outcome as before. So The bottom line in this pair of shocks is that if you do a supply side shock, you generate short run movements in aggregate demand of a perfectly familiar, let's call them Keynesian kind. And conversely, if you do a nominal inflation shock, you cross over in causing adjustments to the supply side of the economy through the capital decumulation that happens as you manage the inflation process. Now, let's now go back to the list that I put up before. This is a list that I wrote down, which I just kind of used as a list to begin with. But this is the necessary and sufficient kit to be able to bring the short run and the long run into operation together. And this is, if you like, how someone who was a PhD student supervisor, if Smets had been writing a doctorate, this is how the Smets Wouters model would have been caused to be written by a good supervisor. But it wasn't. It's a difficult paper to read. Christiano, Eichenbaum and Evans is even more difficult to read. It's just a bunch of first order conditions and no understanding whatsoever. But you can see that when you strip it down to what's going on and you move forward away from the first order conditions and say, this is how it works, you've actually learned some stuff. So that's the first part of my seminar. And just remind ourselves how we got here. Going backwards, 1970s, lots of inflation, terrible time, failure of Keynesian macro management, ISLM isn't any good anymore, that's where we began. And Muth comes along and says forward-lookingness matters. And the RBC people say forward-lookingness means that short-run macro management is a stupid waste of time. The Lucas critique and the impossibility theorem mean it's just pointless given the structure of their model. So let's have fun studying long-run growth. And what's more, let's be clever enough to introduce some autoregression into technology shock. Then in 2 minutes, we can make a second-degree differential equation and produce a cycle, and are we clever? And that was the fun and games that they did in Chicago for 10 years, starting from the forward-lookingness, which these cycles are intrinsically given by somebody understanding the forward-lookingness of that Ramsey model process with autoregressive shocks. The guys in Boston said, ooh, forward-looking stuff's quite complicated. We're interested in short-run stabilization. Can't be bothered thinking about growth theory. It's in the background, too complicated. Put it on one side. But you know, we've discovered that commitment and discretion are very different in the way you stabilize the economy. And let's spend 10 years talking about the difference between commitment rules and discretion rules when we're doing policy optimization in order to give guidance to a central bank. And guess what? When you go to morning tea, these two people have no idea, groups of people have no idea how to talk to each other. And basically, they don't have lunch together and are not very interested in what each other does. And the sociology of knowledge point is that each of them picked up the point about forward-lookingness, but each of them said this is quite complicated, and in order to do it in an intelligible and compelling manner, we better forget about stuff. If we live in Chicago, we better forget about nominal rigidities, and if we live in Boston, we better forget about capital accumulation. And my point in the seminar is just that until we stop that refusal to have lunch together, we'll never get back to a framework which enables us to build an agreed set of conversations on which we can build a platform that we understand in exactly the same way that Klein and Goldberger built their platform on top of ISLM. Now let me give you a whole lot of arguments briefly as to why I think this matters. Because you talk to anyone, talk to Olivier Blanchard, just say, waste of time, David. We teach growth theory in the first semester and we teach short-run macro in the second semester. And my reply is, and in the Easter holidays, the students come to see me and they say, David, how do these two things fit together? No one's explained. Nevertheless, still most people think that this simplification is good enough for everyday life. So I'm going to produce a very quick list of why everyday life needs this simple SENK model that I've produced. First of all, let's do the war in Ukraine, a supply side shock. Let's suppose that the problem will go away in the long run. So first order approximation, energy price goes up and then comes back down again. But let's suppose that in the background, we've got a Ramsey growth model in the economy with low technical progress, low population growth, high savings, probably need an OLG story to get the high savings to work. Thus, with those three things, global interest rates are very low. And then the war breaks out. Well, of course, Gali, Clarida and Gertler say that raise interest rates and to do all the stuff that is explained in the Gali textbook. But when you look back at the news reports on the few weeks after that happened, nobody understood well what to say clearly about what will happen next. And the financial markets were full of turkeys saying interest rates will remain high for a long time because they've been pushed up by this inflation shock. And you say to each other, come on, that's really stupid. And then in the conversation, someone asks you, well, why do you think it's stupid? And guess what you say? You wheel out intuitively in that conversation every piece of the model that I've just put on the blackboard. So right in that important political economy problem that we're now facing, unless you had this model in the back of your head, you basically had to make it up from scratch every time when you were talking to anybody. Let's think about this budget of here and this big fiscal spend. So how do we understand the big fiscal spend? Well, we need, of course, to add a government budget constraint to this model that I set out. And then we need an understand a closed economy to start with. We need to try and understand whether or not we think that the ex-republic debt will crowd out private debt and make it difficult for the growth process to continue as it had been before. And all of us, since the budget yesterday, have all been looking at the 2-year interest rate spread and asking, why is that 4 points, I never say this properly, to 0.4 of 100 basis points higher than it was the day before yesterday. And how do we explain that? The only way we can explain that is by adding a government budget constraint to this model and discussing how that short-run fiscal but sustained demand shock may or may not crowd out capital, and how that will feed back through Tobin's Q into the investment process in the short run. And lots of, we know 15 years ago, there were counterintuitive exercises in which there was a contractionary fiscal expansion. Well, that model can produce that, so that because the higher interest rates feed back through Tobin's Q and can actually make aggregate demand fall now more than the fiscal stimulus. But of course, that's parameter dependent. And so the research project is immediately, are the parameters like that or not? And you have a focus for the important empirical work. And of course, I don't believe in contractionary fiscal expansion. but you can see that I want to understand the general equilibrium structure of this, in order to answer the questions that I've just posed. If any of you read Martin Wolf in the Financial Times, it's now a fortnight ago, yesterday, Tuesday, I think, 2 weeks and a bit ago. He said, why doesn't anybody understand China? And then proceeded in 900 words in the Financial Times to lay out a Ramsey growth model in words, and then say, and this is a country in which population growth has not only collapsed, but going backwards, and in which technology transfer from the US is much harder. Kids can't come home so easily from Stanford, having stolen new ideas in their doctorate. And subject to the way the details, so now I'm talking my model as I continue, we would expect that investment would fall a lot because less capital is needed in the future. How much it falls depends on the adjustment cost parameter in the investment equation and the interaction of that with Tobin's Q, which can be made coherent. But then, in order, closed economy to start with, for this economy to maintain full employment of resources, there has to be a big consumption boom. How are we going to have this consumption boom to replace the lost investment? And then when we go open economy, to what extent can we expect currency depreciation to partly supplement, supplant, add to this consumption increase? And that's just adding an open sector to this model. But you see that in order to just have that conversation with Martin, I've had an email exchange with Martin Wolf about this. And you just said, David, I want to see the simulations with your model that explain what I wrote in my column the other day. And they will. That's my mission, to convince you that they will. And of course, the same is true in Europe. Why is investment so low in Europe? Why is there a threatening recession in Germany? The story is almost exactly the same as what's happened in China. Abstracting entirely from the monetary union stuff, it's just Europe as a whole, a story. Again, you need my model to get a coherent, intuitive account of that. And I just want to mention very quickly the other thing that this model will help you understand, if you are prepared to make technical progress endogenous, and as Wendy Carlin and David Soskis have done in a very nice little piece, which they published in Oxford a few years ago, argue that the rate of technical progress depends on the level of aggregate demand. Demand failure can cause reduction in profits, and that reduction in profits leads to all sorts of theory of the firm details to a reduction in R&D spending, and thus a reduction in technical progress. That model will explain all of those pictures. I haven't got a blackboard and you can kind of see me doing this. All those growth lines that, why did that happen? That until the global financial crisis were going up. I see, I touched the board and something happens. Up. And then come the GFC, and everyone said, would there be a thing? And then we maybe even get back to the same position. And of course, we all know that we didn't get anywhere near back to the same position. What happened is that the line went up at that slope, and then there was the GFC, and now the line's been going at a much slower slope. And all that stuff by Gordon, and the discussion he's had with Larry Summers about long-run technical progress is all exogenous to the macroeconomic process. If you embed a technical progress function of the kind I've just described in my model, you can use my model to articulate your story. Why am I saying this? Because the killer apps on China and on Europe. That's even responding to my hand without getting there. Feedbacks from from the long run onto short run need for big consumption booms, a feedback from the long run to the short run. This last one, the feedback about what happened globally since the GFC is a feedback from the short run into the rate of technical progress and thus into the long run. So you see, every sentence I utter is about this interconnection between the two bits of the story. Next thing to say is that actually this is the way the models run by central banks actually work. It's just that nobody has explained these models to us using my simple story. And I was part of the first ever group to do this with James Mead's group in the 1980s. Now modelling work was done by Martin Wheel, who subsequently led the National Institute and then joined the NPC. We saw the need for a model of exactly this kind because Mead was determined to study the interconnection not just of monetary policy and inflation, but also fiscal policy and the accumulation of capital and public debt and growth. And we wrote a big, thick book, which was very badly explained, and nobody understood that basically, and we didn't understand that the core of what we were doing was this simple model that I'm presenting to you today. So let's start. If you go to both the infamous Beckham model at the Bank of England and the more recent Bank of England model and look at the way they're explained, the only way to read those explanations of those two models is by having this model of mind in your head. It's all words and as if they understand the way the bits fit together. But all they've done is simulate, and they don't really understand the people who wrote these two expository articles for their Bank of England website on what their model was doing, had not understood that this was what they were doing when they described their model. Because all they say, what they did, was write a paper which said, gee whiz, we've got all this stuff. Aren't we clever? But gee whiz, we've got all this stuff isn't the story. The gee whiz, we've got all this stuff has to be combined with saying, I'm going the wrong way. Why have I?
Go back and put it full screen.
Beg pardon?
Now you need to go on computer and put it full screen.
Sorry. Can you help me? Thank you very much. Going back too quickly, we'll be there in a second. Thanks. Is it Control L?
It doesn't work. It's the first.
Thanks very much. So what I'm trying to say is it's no good writing an exposition of the Bank of England model saying, gee whiz, we've got all this stuff. The way you should be writing that paper is to say, and when you use it, it does the sorts of things that I've described in my pictures. I've gone off the end again, I'm afraid. How do I get that back again?
You mean the full screen again?
No, I've lost my click. This is me trying to be so clever and go backwards and forwards.
I see.
And I go backwards and forwards all the way to the beginning and the end. You're just clicking from the beginning. Yeah, thank you. So I don't think I'm going to do that again.
Yeah.
And Warwick McKibben's G-cube model, which is not well understood by many people at all, because it's had 6 production sectors and something like 17 countries, is actually just this model with 6 sectors and many countries. Of course, with many countries, you need a Dornbusch exchange rate model, and you need to make a judgment about uncovered interest parity and the exchange rate, and you need some trade equations linking the countries together. But Warwick has never been any good at explaining his model, and everyone out there thinks his model is a black box. It's just a stacked together set of versions of what I've been describing here. So why am I saying all this? Because I look back with admiration at the way ISLM created a framework on top of which the Klein-Goldberger models were built. What I'm trying to suggest is that armed with a toy model of this kind, we will then be able to understand much more clearly what it is that our central bank modelers are actually already doing. So that part of the claim doesn't even require any more new work. It's simply a claim about a rational reconstruction of the world that we're already in. You can see that just like everyone says the world is not a solo growth model, but at the beginning of any course on growth economics, you start with the model and then you build on it and do an Euler equation to get the Ramsey model, and then you do endogenous growth, and then you do this, and then you do that. This platform that I'm presenting needs to have and can have stuff added to it. You can add in fact, I published with one of my former students on adding Bernanke, Gertler, and Gilchrist to this model. You can add an OLG structure. The real wage resistance story that I talked about earlier in the seminar is added to this structure. An important additional thing to do is to go non-linear. Because in fact, really one of the fundamental complaints that Joe Stiglitz made at that seminar 18 months ago in Oxford was that this linear model that everyone has fun and games with doesn't do large downturns and structural change. And the way you can get this to do large downturns and or structural change is introduce local non-linearities. And all our friends are busy doing local non-linearities with the introduction of net zero and alternative forms of energy. What that, of course, requires is at least 2 sectors, and probably 3, produced commodities and old-fashioned energy and new energy. And then you can build a 3-sector version of this model, and you can introduce a tipping point beyond which the move to new forms of energy production becomes self-accumulating. And then you have to be quite, if you want to solve this model in a forward-looking way, you have to make sure that you've got enough non-linearities at the other end of this locally unstable process that the model won't go off to the sky or down to the bottom of the ocean. And there are good empirical grounds for being able to do that. So you can see that it's what I'm producing is exceptionally simple and straightforward, but it's a platform on which you can build really quite complex stuff. And of course, I look backwards and say, well, guess what? That's what ISLM was. It was exceptionally simple and straightforward, and all sorts of complex stuff was built on top of it. Now, the last 5 minutes of what I want to say, because I am going to finish at 3 and we can talk questions a bit after that and because we didn't start until after court cut, is just to say that this is what a talk which really you could think of as being addressed to theorists. But most of the people in central bank do hard work with data and fit equations and think about empirical plausibility and make projections. Look at this list of 3 things on the page and ask yourself how much of this should be imposed on the work done by the empirical workers. And all of us have a sense that the theorists act probably too much as a thought police, insisting that these conventional assumptions are imposed when the empiricists complain that actually they're doing rules of thumb, mistakes, misunderstanding, persistence, and all that stuff. And these conversations between people, particularly people like me who like having fun with simple stuff, to have fun with simple stuff, you actually need to make these extremely powerful simplifying assumptions. So then you have to understand how to manage a conversation with people whose daily lives refuse to make these assumptions. And that's really quite difficult to have those conversations. And it seems to me, I thought I had an extra point written down, I'll say it verbally, that there's a very good analogy in doing this in nuclear physics. In the early 20th century, Bohr invented the solar system of the atom. And by 1935, Heisenberg had shown that this was particularly misleading because atoms jump from levels in discrete excitations, and you cannot describe them as behaving this way. Nevertheless, in first-year undergraduate physics, the solar system is still taught. The crucial point to make, and it requires proper sociology of science that I'm not qualified to do, is certainly for all the conversations I've had, is that the solar system model doesn't contaminate the work on electrons jumping. Whereas I think it's quite fair to say that these assumptions of the DSGE model contaminate the empirical work, which empirical workers perform in a way which makes them very unhappy. And so there's a conversation there that's difficult and important. There's some sociology of science here, and it's 3 minutes to 3. So I'll just say a few sentences about this. But there are 2 kinds of difficulties involved in these conversations. The first is about purpose, and the second is about method. Here's me with my ambition to understand stuff intuitively simply, and here's you can be the empirical stand-in to do well-regarded, empirical, careful, detailed work with all of these difficulties attached. And when explaining this point to a philosopher at a conversation which I had recently, he said to me, "Come on, David, of course that's difficult, but nevertheless, these people work for central banks and their purpose is to create models which are useful in policy making. And in the end, their purposes are coherent. And in the end, we can use utilitarian modes of discussion to describe the trade-off between David Vine's loss of simplicity and your loss of empirical truthfulness. And in the end, there is an optimal position to aim. Adrian Pagan wrote about this in Bank of England work 15 years ago. I think it's more complicated than that. And I think that we are, and this is my last conjecture on which I end, intrinsically utilitarians as a profession and as individuals, in which we believe that in the end there is a way of resolving decisions and let's use the word conflicts in the manner I've just described. And that's a very early 20th century view. The most famous way of thinking about what that did in economics, that view, is to think about Lionel Robbins' Nature and Significance of Economic Science, in which he ended up saying, we can talk about things where there is a welfare frontier, and we will just not talk about all the things to do with interpersonal transfers of well-being, because we don't know how to talk about that. And we'll narrow our discussion to the point where we can only have utilitarian maximizing conversations about choices. In political, moral, and philosophy and in epistemology, I think things are not now any longer thought of as simple as that. We live in the university where Isaiah Berlin made a career out of thinking and writing about incommensurability. And this is a difficult word to define and unpick. But a simple sketch, which I think is illuminating, is the way I've always explained this when talking about this idea to undergraduates when I'm teaching development economics, where there are quite difficult choices between alternatives to be pursued. And I say to my students, just imagine David Vine's career. He's spent his whole life living in England and pining to go back to Australia. He really wanted to go back to Australia. And in the middle of his career, he's offered a really good job at the Australian, this is for his story, Australian National University. And he's, what you might say, in the balance as to whether he'll stay in England or go back to Australia. And so I asked my students, just imagine, this is the Australian National University, just imagine the HR division full of clever people at the ANU, and they say, you know, he's at the margin, on the balance. Let's just ring him up and offer him a free car. And since he's so nearly on the edge, that'll make him come. And I say to my students, it won't, it wouldn't, it did. And I had a particular life story about actually something like that happening. And when that had happened, I picked up the phone next day and said, actually, I'm not coming for the job. Now, that's about a person's particular decisions as an individual. That conception of incommensurability is, I think, at play in the discussions between intuitive modelers like me and detailed empiricists. You're the standard in this conversation, in which, in the end, you will not yield on these empirical questions. And in the end, I will not yield on simplicity. And it turns out that our reasons for doing those two refusals to yield are very complex. And so that's a way to end. You've seen me go right back to the beginning and say, I think that we need toy models because toy models help us understand what we're doing. point one, I've shown you how I've got my friend, my toy model, which I think will change. I can't say will. I'm of course not in the position that those wonderful Hicks, Mead, and Harrod were when they changed the world in making the world understand Keynes. I don't think I'm going to lead an intellectual revolution, but you can see I think I should have, to have a simple toy that will really encompass much that matters. But the second part of my talk is that once having created a toy of which you are proud, the conversations that you need to have with the detailed empirical modelers are very difficult conversations, which go right back to deep questions about the philosophy of science. Thank you all very much. Is there anyone online who wants to ask anything can penetrate?
Yeah, David, can I make a few comments?
Yeah, please, John.
The add-ons you suggest actually radically transform the basis of your approach, because your approach is rational expectations, model consistent expectations, infinitely lived households,
Yeah.
and all that. And there are no banks, there's no credit, no asset prices. Monetary policy transmission works entirely through intertemporal substitution, except for investment. There are no asset prices. In China, the property market implodes.
There's Tobin's Q, which is
a huge part of the Chinese story.
Yeah.
So, how can you sell this to central banks who are interested in financial stability and in how monetary transmission actually works? Through cash flows, through credit, through all kinds of mechanisms that aren't in your toy model.
I think the reason. Let me give you two answers to that question. First of all, nobody ever believed that the LM curve described reality. The LM curve was a device which Harrod persuaded Keynes to put in the general theory so that Keynes could make peace with Dennis Robertson. Nevertheless, the ISLM model provided the framework, and we all know that Klein-Goldberg had ditched the LM curve and got on with doing stuff. But the framework was important for them. Now, I want to say the same thing about what I hear with my simple toy, because I've been to many of your seminars, and I find your spaghetti quite difficult to understand. You understand the details of your spaghetti in those diagrams, but almost nobody in your audience does. And you perpetually say it's your job to read a bit more and think a bit harder and to take out your knife and fork and really understand my spaghetti because every detail in it is important. We are having the conversation that philosophers of science regard as very difficult, because of course you can make me look ridiculous, but of course for me to describe your proudly assembled seminars as spaghetti is designed to make you look ridiculous, and these are hard, and I will still speak up for a framework which provides intuition, even though I need to respect your spaghetti, but I want to glue it onto what I've done. And if I were you, I would say, but David, aren't you constructing a detour? The world is my, so let me try and climb over the fence in your direction. The world is my spaghetti, and your simplistic toy is an impediment to getting to the spaghetti. And so my response to that would be to try and say, can I still maintain my intuitive understanding by not having a representative agent, but by understanding that there are spreads of agents? by having at least two sectors so that there's inequality some do much better than others, and to having at least two sectors, part of the important difference about technical progress, privileging one sector and not the other. Two kinds of workers, one poor with assets and the other with no assets, and the other with assets. Of course, I respect the need to have all those things, but I want a simple platform to start with. And so why not make it backward looking? Okay, I give in immediately. Why not try and understand like a Hank model being done in London, and in which there are at least two kinds of consumers, all give in immediately. And at every stage, I'm walking in your direction, and we're having a discussion about what a hybrid model, important term, should look like, and where the compromises should be made.
Well, I'd be very, I mean, the RBA, the Reserve Bank of Australia, has a policy model which now incorporates a connection between the banking sector and the real economy, which is really quite thoughtful. Adrian Pagan advised them to go in that direction rather than in the DSGE direction. Now, I'm wondering whether, in the Australian context, any of the questions the big questions that you raised about technology and so on, whether that model is incapable of answering those questions within its framework, which is not at all DSGE.
I think I've been partly involved in the core policy discussions in Australia, which were that fiscal policy was too tight during the period from not immediately after the global financial crisis, but from 2012, when China rode back its expansion and Australia lost its booming mineral and coal exports. Continued to be large, but nowhere near as large. And at the same time, the fiscal austerity hawks insisted on 1% fiscal consolidation for 6. Now, I want to say that a complete macro model of my kind is equipped to help you understand that important set of questions. Indeed, Andrew Lee has written rather a nice paper arguing that something like 750,000 more people are unemployed than needed to be if the policy had been sensible. Now, I don't want to add a silly sounding sentence, but so I will, and say that set of discussions doesn't require the kind of careful, articulated understanding of the financial transmission process that you would want and think you need. Maybe what I've just said is a mistake, in the sense that the low interest rates, which because of fiscal consolidation, so here again I'm rowing in your direction, because of the fiscal consolidation at a time of much lower export revenue, monetary policy needed to be looser. And I'm now, this discussion, there was very nearly civil war in the central bank in Australia because a faction who won the argument refused to lower interest rates in the way that would have been necessary to pursue full employment of resources. And they did that because of their understanding of the working of the financial system.
In 10 minutes.
In 10 minutes.
So I think I'm saying that that both kinds of understanding are necessary, because the detailed understanding of that you've just described isn't the main player on the stage in that fiscal versus monetary cooperation story, which was centerpiece in Australia. But what I've just said is that forcing monetary policy to behave in a silly way because of this fiscal policy created dangers which about which there are arguments, and an understanding, you know, should they have had looser policy or shouldn't they have? And an understanding of that argument necessarily requires the kind of detailed model that you think is important that you've built. So isn't that a sensible compromise position to end up in?
Yeah, I'm just wondering to what extent. I mean, if you were to look through the RBA's model, where do you think the big emissions are that causes it maybe not to answer the questions that you would like answered? It would be interesting to see your critical take on their model.
Well, so thank you. That's a proper question, which actually I will pursue with people there. But because thank you, John. Yes, we'll have this conversation over the next few weeks. Is there anyone else? Do you want to say more, John?
No, that's fine. Quite enough for me.
Is there anything that anyone else would like to say? Still a number of you online. But if not, then I think we'll wind down. Thank you for those of you who stuck out the long wait at the beginning.